Johnny, I just saw Johnny's comment. It threw me off when I hit record. That is absolutely hilarious. Johnny got kicked out. Johnny got kicked off Economic Ninja's page. But anyways, guys, good morning, Real Estate Mindset. Welcome to another morning live and happy Tuesday to you guys. We have massive movements right now with the 10-year treasury. The 10-year treasury right now is absolutely exploding. So we're going to talk about that, what impacts that's having on mortgage rates, on the housing market in total. I got some really, really good stuff for you guys today. I will have everything chaptered, but I want to tell you guys first, the good news is actually great news. A cold front is entering Texas. So I get to go outside to make videos again, and I don't have to suffocate in the humidity. So really excited about that. I'm also really excited because we had, I think, 25 people sign up for the free home buying course that I put out last night. So I was a man of my word. I stayed up late and I got it done for the channel members. So really excited about that. And understand, some people didn't understand why I was talking about a home buying course, but I'm not saying to buy right now. I'm saying that if we're on the sidelines, learn how to buy right now. And that's really what the course is about, learning how to do those things as we're on the sideline waiting. So anyways, guys, we're going to jump right into this right now. All right, let's go. So first of all, let me show you guys, I'm going to get back to this article, but let me show you guys what's happening with the 10-year treasury right now. So take a look at this, guys. So the 10-year treasury, okay? So this started plummeting, what was it, last week when the war with Israel was going on. And just like that, you guys, it doesn't matter anymore. It's right back up to where it was before. You guys, it is up today 14 basis points. So it's down a little bit right now at 13.5. But this sucker, this bad boy right here was up 14 basis points. This right here, this 10-year right here is the economy killer. This is the business killer. This is the resetter, the world resetter right here. It's the long end of the yields, and that is absolutely skyrocketing, guys. Now, the thing is you guys see this spike right here? So it was already up. We started this morning up, I think it was about 6 to 7 basis points. So it was up 6 to 7 basis points. But you guys see this spike right here? This spike right here is because of this right here. You guys, here's the thing. Inflation is still here. Inflation is out of control. People are still spending like crazy. The credit card debt is exploding. I mean, everything's exploding right now. But what's really happening is people aren't going to be able to afford that debt eventually. They're just getting in more and more debt. But anyways, let's read this article again. Once this article came out, that 10-year skyrocketed, like double where it was at before this article. So this goes on. Retail sales rose 0.7% in September. Now, here's the problem. That's much stronger than estimate. Okay, now let me just read a little bit of this so you guys understand why the market is freaking out right now. Consumers showed surprising strength in September, boosting retail sales well above expectations despite high interest rate and worries over a weakening economy. Thank you for being honest about the weakening economy. Retail sales rose 0.7% on the month, well above the only 0.3% Dow Jones estimate. It was double. You guys, it was more than double estimates. That's like, who's making these estimates? This is crazy. The numbers, however, are not adjusted for inflation. So they include that consumers more than kept up with price increases. The Consumer Price Index released last week showed headline inflation up 0.4% in September. Treasury yields moved higher following the report, while stock market futures remained in negative territory. So what does all this mean? All this means is higher for longer. It means we're going to have higher interest rates, and they're going to be that way for longer. Now, I want you guys to think about this article for a second and think about what the real problem here is, and also understand how important credit tightening is. Credit tightening is going to be especially important in the cycle, but I want you guys to comment below and let me know if you think that the consumer is really strong right now. I'm going to tell you what I believe is happening and what I believe is a result of those higher than expected numbers. Now, obviously inflation. Okay, so inflation. So it appears high because of the inflation, but also, y'all, the credit card debt. I mean, it's not like we're guessing here. Credit card debt's exploding. I mean, it is literally the trajectory of spending on the actual credit cards is skyrocketing. The trajectory is completely out of control. I believe all we're seeing here is consumers charge credit cards overall. That's mostly what we're saying. Now, how can they do that? How can consumers continue to charge, being that we're under quantitative tightening in the front end of a recession? How can they do that? Because we're coming out of massive stimulus, massive money being pumped into the economy. The consumers still have that money. During the COVID lockdowns, they paid out, a lot of people, not all, paid off their credit cards. So they started at zero in 2022. In other words, you guys, they had the money to spend on their credit. All right. And that's why we're seeing such lags. We see such lags in the market. And just to add insult to injury here, using my own situation, back when I lost everything, okay, back when I was a kid, now I feel like I'm a grown man, I'm an old man, whatever. Back when I was a kid, and I tell you guys this all the time, I lost everything in California. I started in real estate when I was 18. I made $1 million by the age of 23, but I lost everything, literally lost everything. And I wanted you guys to understand the psychology of what people are going through right now. People are going to naturally keep their head in the sand, naturally, because most people want to feel comfort, right? They want to feel comfort. They want to stay in the bubble that they've created. And the problem with doing that is there's an entire world that goes on outside of our door, outside of our feelings, outside of our goals. There's a lot of stuff going on. So back in the day, and I'm going to tell you guys, literally right before I lost everything, I had the worst spending habits of my life. Again, right in the front. Actually, we were partially in recession. Back in 2009, I was spending more money, more recklessly than in my entire life, right in recession. And the reason, guys, that I did that is that's the lifestyle that I got used to. I kept my head in the sand and I was foolish and I just kept wanting to do the same thing over and over again until the recession was knocking on my door and said, Travis, you lose. And that's what happened, you guys. So honestly, I think it's normal. I think it's sad, but I think it's normal. I think people are going to go to the end. And that's what I did. I spent recklessly and foolishly, again, you guys, into the end. But let's go back into the treasury markets and let's see what's going on with the money. Oh my God, look at this, guys. I mean, what we're doing here, guys, is we're watching the money. Look at how close. This is insane. Look at how close it is to 5%. So again, here's the economy crusher. This is crushing the economy. This is the long end of the yields. 15 basis points. This is crazy. Take a look at this, guys. Let's keep going. Now, take a look at the inversion, the 10 and the 2. All right. So the 10 and the 2, again, it started, inverting again when Israel went to war. Okay. Or rather when they were attacked. But as you can see here, the market is just so merciless, you guys. The market is just so merciless. But the inversion is up again. We're at 38 basis points. And I'm going to tell you guys right now, listen to what I'm saying. By the time that this updates today, we will probably be, I would say, close to another, probably like a 1-year record of uninversion. So when this updates today, we're going to be even less uninverted. Again, why is that important to watch? Because generally we enter recession a couple months after this reinverts. But look at what's happening, guys, with the short end. Okay, so here again, here's the long end's exploding. Why is this exploding? Because people don't want the 10-year. People don't want this. People want the short end right here. They want this. So that's why you guys see the long end exploding. Look at up 15 basis points, but the short end was actually down. So why would that be, you guys? You guys should probably know by now, some of the reasons why that would be. And actually the interesting thing is the 1-month treasury started down. And remember, I refer to the 1-month treasury as the liquidity and excess savings killer. So the long end, economy crusher, short end, liquidity killer, okay? So why would this be going down essentially when the 10-year is going up? Because remember, you guys, when people sell this 10-year, it goes up. When people buy the 10-year, it goes down. So it's realistic to assume that people are flooding out of the long end. And what are they doing? They're putting their money in the short end, right? And the 1 month or the 6 month. Now, let me explain a little bit more on how this is a liquidity killer. Because remember, we've been talking about the reverse repo market. The reverse repo market is a decent gauge to see how much liquidity and money is still in the market. So take a look, guys. Again, 1 month is at 5.4. Look at the overnight reverse repo is at 5.3, okay? Now, I want to let you guys know that this did drop to 5.38 today. So there is movement in the 1 month, and it actually did go down. But the reason I'm pointing this out is, it went down to 5.38, but look that's not necessarily enough difference between the 5.3, which is the 1 day, versus the 5.38, which is the 1 month. In other words, what I'm saying is this, okay? We want this 1 month or even the 6 month to be as high as possible over the reverse repo award rate. And basically what that is that's the rate that banks get for holding the money in this account for one day. All right, do y'all understand what I'm saying? But look at the trajectory. This is the actual reverse repo market. Right now, there's still 1.1 trillion in the reverse repo market. Okay, why is this important? What's important about this is understanding the trajectory, because this is the money. We want to watch the money. When we watch the money, we have a better indication on like what's going on, because we know we can't trust people and their biasness that are paid to be biased. I mean, come on, let's be honest. But look at the trajectory, guys. It is going down rapidly. Okay, rapidly. So again, the more that 1 month and the 6 month goes up, the faster that this goes down. Once this money runs out, fireworks will start. Let's continue. Now, quantitative tightening, okay? What do I mean by once this money runs out? What am I saying by all of that, okay? What I'm saying is that the Federal Reserve is doing quantitative tightening, all right? I'm not talking about raising interest rates. We're talking about quantitative tightening now. So what they're doing is they're selling these 10 years and they're selling the 1 year, So they're selling the 1 month treasury, okay? So the Fed, the government selling these 1 month treasuries, and then they're taking the money and they're burning it. Okay, they're getting rid of it. They're deleting it out of the system. It's quantitative tightening, and you see that here. All right, so if you guys want to see, now this is the other money. Okay, we looked at the reverse repo market. This is the assets held right here, and you guys can see that this is going down. It should be going down, faster, but they are making progress in quantitative tightening. So keep your eyes on that. Here's what happened. One of the things that happened at the beginning of this year. You say this basically the Fed paused and did this, a moment of quantitative easing. I'm going to call this the quantitative easing. So during their quantitative tightening, which is what you're looking at here, here's the quantitative easing that happened in March. This was the bank runs right here. And essentially that created more inflation, changed the sentiment. The Fed came back. It was alive, blah, 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 blah. So anyways, I hope you guys have a little bit better idea of how the quantitative tightening is working and why it's so important to watch the money. And honestly, guys, I'm sick and tired of hearing these suits. I don't have a suit on today. I just have this button up. I'm sick and tired of wearing these suits because, literally, it's like every time I think someone's making a good point, like, yeah, okay, this guy's getting it, they just go off the deep end. Like, just as soon as they start making a good point, they go off the deep end and try to push us back around to everything's okay and just buy. Am I the only one that's hearing this everywhere? Everything's okay. Just buy, but the default rates on literally everything is now above pre-pandemic, including mortgages. I'm sorry, mortgages. We're not talking foreclosures. So I'll have a video this evening about foreclosures being at pre-COVID levels finally. So that's all there. Now we're going to go into our first video, y'all. In our first video, let me put my timestamp. Man, I was rambling. Our first videos is going to be about the housing market and the housing market changing into a buyer's market. So housing market changing into a buyer's market, but still this guy is just, it's so hard for me to listen to these guys. But if you guys can, let me know that the audio is good. I love you and enjoy.
Let's talk housing. It's one part of the economy where high interest rates are certainly being felt. Philadelphia Fed President Patrick Harker saying today those elevated rates are raising borrowing costs and limiting inventory, leading to higher prices and roadblocks for first-time home buyers. The average mortgage rate is around 7.57%. That's according to Freddie Mac. It's the highest since late 2000. That's for a 30-year fixed. Joining us now is Matt Ishbia, Chairman and CEO of UWM, United Wholesale Mortgage. He is also owner of the Phoenix Suns and Mercury. Matt, it's great to be speaking with you again. And that is exactly where I want to start with you. The fact that we have this logjam between home prices that are still stubbornly high, mortgage rates that we've seen pick up to 2-decade-plus highs, and then inventory that's also at historic lows.
Yeah, no, it's obviously interesting to see all this stuff happen together. But what I would say a little differently than some people is like people are thinking people aren't buying houses still. There's a lot of houses for sale and a lot of people are buying them. First-time home buyers. Some people are realizing like, wait, if I wait till rates come down, well, more supply, well, guess what? The prices will go up even more. Right now is actually a great time to buy. You lock in your rate, your 30-year fix. It's high rates. Rates are higher than they were before. They're not 3% anymore, but 7.5, 7.5, 7.25, whatever they may be. You got to go to a mortgage broker. They'll find the right deal for you. But the truth is, it's a good time to buy right now. There is inventory out there, and there's a lot of young people buying houses right now. So we're seeing houses move, maybe not as fast as we've seen in the past, but it's still been pretty busy for us.
It's interesting to hear you say that. I realize you're in a quiet period right now, but it's interesting to hear you saying that because we have seen, last month is a good example, with the Mortgage Brokers Association saying mortgage demand was at its lowest level since 1996. You're not seeing that?
Definitely not since 1996. No, we had a great second quarter, all-time purchase second quarter, and third quarter was not far behind. It was a great quarter as well. And so I'd say it's definitely not the boom of 2020 and 21, but the reality is people are buying houses, people need mortgages, and the people that are the best at that, which are mortgage brokers, are still pretty busy, and we're the best lender for the mortgage brokers, and that's why we've been pretty busy throughout. Now, it's going to get slower in the fourth quarter and first quarter, and if rates are 7.5%, 8%, of course it's slower, but it's not like nothing's going on out there. I think people overstated a little bit. Although it's slower, it's not dead out there.
Okay. I mean, we're in the midst of bank earnings right now as well. And of course, there's been this focus for months now on credit tightening and standards for credit tightening, where the banks and those more, I guess, traditional lenders are concerned. Has that been a boon for you?
No, it's not been a boon. The only thing that's a boon for us is people need, like, mortgages are a weird thing. If you're buying a house, you need a mortgage. You don't want one, you need one. And so you got to make it faster, easier, and cheaper. And when you're a specialist like mortgage brokers and UWM is, we're actually the ones people go to. And so banks do great things in a lot of respect, but they're doing so many things. And so we only focus on one thing, which is mortgages. And we try to make it fastest, easiest, and cheapest. And that's what we're all about. So it's not a boon for us that other people are, but we're just focused on it. That's all we do. 7,000 people. How do we make this faster, easier, and cheaper for consumers? And that's what we focus on.
We were just talking about,
right.
The Fed and this ongoing message, this drumbeat of higher for longer. How does that affect housing if you see that continue to stretch out, even as inflation comes down into next year?
So I don't really see that how it's going to go. I think by the election next year, rates will drop, is my personal perspective. Do I have great data behind it? Not really, besides a lot of different things that I've read and looked at and researched on. But with that being said, if it stays higher for longer, that's fine. People are still buying houses. And the best thing is when rates do drop, because they are going to drop, whether it goes from 7.5 to 6.5 or 7.5 to 6.25, at some point they drop. All these people that are buying houses are going to refinance and are going to save more money, which then helps the economy, helps spur positive things. It's like there's a lot of good things happening. And so people kept saying, if you remember last year, they're saying housing values are going to crash. The whole world's going to fall apart. Well, housing values went up again, 3%. Like we said, they would go up a normal amount, maybe not 15%. So a lot of doom and gloom out there. And it's just not reality if you're really in the weeds of the business like we try to stay.
Well, okay, guys. So he's really in the weeds of the Pro. First of all, I'm like, what's this dude? I mean, is he high on drugs? I mean, the dude seemed high on drugs. How is this guy even on TV? He seems like some hyper energetic, like, cheerleader. Yeah, I don't know. Maybe it's just me, guys. But you guys, you guys see what I'm saying? They bring up good, like, decent points, and then they just jump off of the deep end. I mean, he's saying that, don't worry, people can save a whole bunch of money because they could just refinance later. What do we know about refinancing? What do we know about amortization schedules? If you refinance, you start all of those fees over again. Add $50,000, $60,000 in interest cost on top of refinancing. Because remember, again, you guys, the amortization schedule starts over again. And the thing is, that's even if people qualify. People may not even qualify. This guy's out of his mind. He's saying the solution, and I threw up a comment, the solution is refinancing. He's out of his mind. The solution is affordability, not refinancing. I'm just saying, guys, I don't know if you agree, but we're going to go into mortgage rates right now. And we're going to talk a little bit about that because we need to understand how bad refinancing actually is and obviously how bad amortization schedules are. But here's where we're at with interest rates. We are 1 basis point off the record. Okay, for this cycle, I'm saying this cycle's record, we're 1 basis point. The record was 7.81 about a week ago. October 6th, we're at 7.81. So this is what I'm going to say, and I will put money on this, guys. When this updates today, I don't know when it will update, between 1 and 3 p.m., I believe, it's going to be a new high. So we're going to hit a new record high today when this updates. And remember, I said you guys probably going to want to lock your interest rates if you're shopping. I hope you guys did that because guess what? They're skyrocketing once again. So this will update today and we will have a new record high interest rate. And you guys, it is possible we hit 8%. I'm going to tell you guys, because again, look at this. Okay, look at the long end. The long end's up 14 basis points, okay? We get a bigger hit on the interest rate. So that's up 14 basis points. This should go up more than 14 basis points. So this might hit 8% today. Might hit it today, you guys. That is freaking nutso. But let's see what type of damage the 7.8% does by pulling up this amortization schedule. I pull this up every freaking morning live because I need you guys to understand the trap. I need you to understand mortgages are a prison. A 30-year mortgage is one of the worst debts you can have. And refinancing is way more expensive than most people in America realize. It is so expensive to refinance. It's just the problem is almost everyone is sold on payment, and they don't look at what matters, the price, because the price matters. Why does the price matter? Because how long is the payment going to last? Is the payment going to be forever? People are just so stuck on payments. But look at this, guys, okay? I'm putting today's interest rate of 7.8%. You guys get a loan right now for $328,000 at 7.8%. Your real interest rate is not 7.8%. Your real interest rate is more like 150%. It's not 7.8. It's 150. Look at the interest. You guys pay back $522,000 in interest. Now, is that tax deductible? It is in my case. So I understand there's tax benefits of paying interest, but there should be. That's $522,000. That's $500,000. But look at this, guys. I'm always telling you, okay? After you close, pay down your amortization schedule. It can be more powerful than the down payment. But if you put a down payment and additional money towards principal, like Comic and I went over a couple other lives, it is also effective. But a down payment alone, listen to me, a down payment alone is not as effective as this, okay? A down payment plus additional money towards principal for whatever the differences in payment is. So understand what I'm saying? But look I always try to show you guys what it would take to pay off 5 years of your loan. 5 years of your loan, okay? So hold on one second. Where did I put this? I looked at a comment and it threw me off. That always happens to me. But anyways, to pay your loan down for 5 years, it only cost $16,752. Less than $17,000 to pay off 5 years of that sucker. You guys, that saves you $124,000. That is a lot. But real quick, this is a comment that I was looking at, threw me off. Travis, is renting a trap? True. Overall, you have rents gone down. So here's the thing. Is rent a trap too? Well, the thing is, like, when it comes to, okay, brother, living in Omaha, you're a realtor. You already know the answer to this. You know the repercussions of foreclosure versus eviction, right? An eviction may go on your credit. It may not. If you have a foreclosure, you lose everything. Do you hear it? And not only do you lose everything, if they don't sell the house for what you owe, you get something called an insolvency notice. Like I had, remember when I said I had a tax lien for $150,000? That was a result of my foreclosure. So when someone says like trapped, what is a lease usually good for, Omaha? What is a rental lease? How many years? 1 year, right? 1 year, 2 years, right? How long is a mortgage? 30 years versus one. You see my point? So I don't want you, Omaha, and I really appreciate you joining our community. And I'm hard on you because you're a professional and I appreciate you showing here. I don't want you to start pushing that ridiculous narrative on how beneficial renting is. I'm sorry. I apologize. How bad and evil renting is. What, in my opinion, Omaha, and this is why I spent so much time on this free home buying course, I believe what people should be doing right now is empowering themselves and increasing their purchasing power through this toxic housing market. It's a very toxic housing market right now. Y'all see what I'm saying? I'm getting a call from, darn it. Anyways, I shouldn't have looked down on that. But my point is, we need to teach people how to buy. And right now, there's not a lot of premise to buy right now. And what do I mean, Omaha? What do I mean by teaching people how to buy? Wedge, cash flow, affordability, no consumer debt, emergency fund, not using your emotions, using the data. Don't start with, oh, you're stupid to rent. Don't start there because that's done. We're done with that. We've grown past that, right? I'm hoping so. And Omaha, I appreciate you, brother. And you guys listen, this is why I'm pulling up Omaha's comment right now. You have to understand, Omaha has a bigger impact than most of you watching on the real estate market. Omaha, and you call it what you want, but he's the one that's in front of home buyers and home sellers. So it's really important that as a community, not only are we empowering ourselves, but if there's a professional that wants to learn and wants to grow, we should welcome that in our community, because remember, they're in the front lines talking to people. And Omaha, That's my point. And that's the side of the coin. And I hope you see it. I appreciate you being here. But anyways, that's just my opinion. But let's go on to the next thing, you guys. Affordability. I like this one, Omaha. This is something that everyone should be using here, especially if you're a realtor. So what I like to do is show you guys how much someone qualifies for with $100,000 and then how much they qualify for when they have no consumer debt. So right now I'm showing the average consumer debt payments is $1,400 a month at $100,000. That would bring your purchasing power to $291,000. Basically, almost all of America cannot afford a house right now. I'll be making another video on that, just how bad affordability is. But let me show you guys something, okay? That's what they qualify for with being in consumer debt. When you have no consumer debt, okay, and again, understand how bad consumer debt is. When you have no consumer debt, your approval goes from 291 to 468,000. That is a difference of $176,000. In other words, this is what I'm saying. That is a difference of 60%. You guys should be excited about it. The average person, say the average person making $100,000 can get 60% more purchasing power if they just had no consumer debt. But I'm not saying like close your credit cards. I'm not saying that. We need to play the credit card game. But I'm saying, holy smokes, right? Do you guys start to understand like how bad it is to like spend your money right now to get in debt? It destroys your purchasing power. And honestly, that's exactly what we need right now. We need strong purchasing power. So the next thing is we're going to go into another video. This is a really, really good video. It may be a little bit boring. I hope it's not too boring for you guys, but she's going to go into all kinds of good stuff, basically going into the bonds again, the yields, the bonds, okay? Because again, that's destroying the economy. The long end's destroying, the short end's sucking liquidity. So remember that. But also remember the black swan events that we have happening, what I believe is going to lead to increased unemployment, which is the corporate debt, corporate credit. So this video is going to go into like corporate credit tightening, again, which I believe is going to lead to more unemployment. The more unemployment, the more inventory, the more price cuts, the more foreclosures, right? But we really don't have that unemployment right now. Even though it's trash numbers on the unemployment rate, people could still get 3 crappy jobs, right? I know all the full-time jobs are like disappearing, but nevertheless, people can still get a whole bunch of trash jobs. And that's a fact. When I went through the great financial collapse, I couldn't even get a trash job. I know that because I tried. Can you believe your boy got shut down by Walmart? I got shut down by Walmart. I can't believe that. Anyways, you guys, I hope you like this video. Please let me know that the audio is okay.
Now for more on the markets is Oksana Aronoff, who is head of market strategy and alternative fixed income at JP Morgan Asset Management. And welcome. Thanks for coming in today.
Thank you.
Let's talk about the economy and what that means for rates, because that has to be driving every decision that you're making for investors right now when it comes to fixed income.
Absolutely. And it's really fascinating to me. We had, just a year ago, we were pushing 490 on the 10-year. We had a monster job beat. We had a couple of weak Treasury auctions. We had a beat on the PPI. We had a beat on the CPI. And yet we've seen a rally in Treasuries while risk sectors like equities, like credit risk, have actually continued to move up unabated, even on the events in the Middle East. We're seeing the Treasury rally give up some this morning, but really this is about the push and pull, right, between the geopolitical risks and the strength, the continued strength of the U.S. economy, as well as continued technical challenges to the bond story, to the rate story, and the fact that there are larger Treasury auctions. The Treasury is trying to finance tremendous deficits at a time when the largest sources of demand are stepping back.
Yeah, let's talk about that last part first. Just the massive deficits the Treasuries need to get more and more money, bringing more Treasuries into the market. I think last week's auction was maybe a little surprising with some of the stuff that went, especially with the 30-year. What do you hear from clients? Do they raise these same questions about concerns about, hey, what's going on with the deficits, and do we really want to be buyers at these levels, or we'll hold out for higher?
I think definitely those questions are coming through. They're coming through in the fact that that long end of the curve has been pushed up so significantly. The Fed has only raised 25 basis points since May, and yet we've seen this tremendous push up in the long end of the curve. So finally, right, the bond market is noticing the sort of financial underpinnings. The fact that, of course, the Fed has not been able to get services inflation under control, and now we're possibly seeing a reigniting of inflation because of, oil and some commodities, some other pressures. So we'll see how that plays out. But certainly the technical picture is an important one. We have, something like 30% of outstanding Treasuries maturing over the next year and a half. You have the Fed selling $1 trillion of treasuries. You have the largest foreign buyers. China has been lightening their treasury load by about $300 billion a year since 2021. You have banks that are not net consumers of treasuries, right? And all of this is happening as the treasury is trying to finance $1.5 trillion of deficit spending. So, and when you kind of pick up your eyes and look out over the horizon, right, in terms of secular trends, we're likely going to continue to see more pressures with respect to inflation, because whether you look at demographics, whether you look at some of the green energy initiatives, right, all of those things, the populist trend generally, globally, all of those things are inflationary in the long term.
At least there's got to be a floor that's underneath treasuries when it comes to the yields on some of these issues. Lee Cooperman told us last week at a CNBC conference that he wouldn't be touching the longer term bonds below 5.5%, because he just thinks the trend is only up from here.
It makes a lot of sense, because historically the 10-year has really been the sum of growth, inflation, and a long-term premium of some sort. And when we just simply look at growth and inflation, right, that should bring us over 5%, and we're not there. And I've been saying that, look, the 10-year is still, even at some of its peak levels a couple of weeks ago, is still very much priced for a 2% inflation world. And if inflation does settle closer to 3%, then that will absolutely mean a repricing at that end of the curve.
So is that where Jamie Dimon gets some of the comments he makes about this, where he thinks, look, not that we're necessarily headed to 7%, but it wouldn't shock him?
I think
businesses should be prepared.
I think we're in agreement with that statement. Yeah, I certainly can't speak for Jamie, but I think generally we're in agreement that technical pressures, longer term secular pressures with respect to inflation, and the fact that I think the Fed is just generally, I think Jay Powell is generally content to sort of demolish this really unhealthy relationship between asset prices, right, and Fed policy. And I think investors waiting for the Fed punch bowl to come back in the event of a slowdown will be wholly disappointed. So unless we see the economy in some kind of a free fall, yes, central banks will probably get re-involved, but a garden variety slowdown is not going to
They're
get
not coming to the rescue.
No.
So what do you tell investors to do right now? How that's completely changed the paradigm of what we've gotten used to in the last 15 years or so.
Absolutely. So what we've been saying is that the next 10 years are going to be nothing like the last 10. There's going to be a lot more volatility to bonds. We're seeing it in the MOVE index, which is settling where we used to live pre-GFC. It feels like bond volatility is elevated, but really it is exactly where it used to live before the great financial crisis. And so we're saying, look, you have to preserve optionality in the form of liquidity because it is paying you, but you absolutely have to attack opportunities as they arise, whether they're related to the banking sector earlier this year, whether they're related to commercial real estate as this year continues to move along. And one area where we think there'll be a very meaningful repricing is corporate credit risk, right? We saw the Rite Aid default this morning. Even before that, this year was already in the top, 5-6 years of defaults, and we're still, 3 months away roughly.
So
it's
not pricing it in yet.
Absolutely not. Credit spreads are wildly optimistic about the default prospects. We've tripled defaults since the start of the year, albeit from very, very low levels. But the default cycle is underway, and we're going to continue to hear the drumbeat. So there's going to be some really interesting opportunities to get involved. And right now, you can sort of clip that coupon at the front end of the curve, but certainly there are things to do for investors with liquidity and with the toolkit to take advantage of the volatility in markets.
Not the sunniest news, but some interesting news for investors. Oksana,
great.
All right, so some interesting moves from investors. And here's the thing, you guys, no one's touching the 10 years right now. I mean, there's so many people not touching the 10 years. That's why that's one of the primary reasons, you could maybe the 30 year as well, but that's why there's bank runs. That's why the bank runs happened. So, when I listen to that, I'm thinking to myself, like, the market is finally noticing quantitative tightening, like finally, and it took them a long time because, again, the massive amount of stimulus, but okay, here we go. All right, so Omaha, so question from Omaha again, Travis, when you lost it all back in the Great Recession, could you give an example of your reckless spending? Yes, sir, I bought an overpriced house. All right, next question. Real quick. So all the full-time jobs are disappearing. So RJ, just to clarify, I assumed you understood what I was saying. So I just wanted to clarify because I know you didn't. What I'm saying is in the job numbers, the job growth numbers, right? What do we see job growth in? We seen job growth in full-time jobs, or are we seeing it in part-time jobs? Look at the numbers. I'm just saying, if you don't know that already, look at the numbers, guys. Look at the numbers. All right, now what I want to do is I want to do something special. I want to show you guys MLS. Okay, I'm going to show you guys how to use Zillow. So first of all, let me pull up my MLS and I'm going to show you guys. This is the Houston MLS. Okay, after I'm done doing this segment, I'm going to show you guys how to use Zillow in a similar manner. So again, my goal in this section of the video is to show you guys my MLS, to show you what's happening, like the truth, what's really happening in Houston. So I'm going to show you that, and then we're going to come over here to Zillow. And I'm going to show you how to do something similar with Zillow. It won't work in every state. It will not work in non-disclosure states like Texas, unfortunately. But you guys, here's what I do, okay? As a realtor, I have access to all this information. So the first thing I want to do is show you guys price decreases, okay? So I click price decreases. I'm going to show you the map here, just in case anyone thinks that Houston is overwhelmingly like hot right now. The thing is we don't have a lack of inventory. We have a lack of affordable inventory. Look at all the homes with price cuts, guys. Let me zoom in a little bit here. Okay, so these are all the homes in Houston with price cuts. I mean, look at this. Oh my gosh, look at this pocket right here. So there's a pocket right there that's not selling. Do you see how you can see little trends? Look at this. Here's a pocket right here that's not selling. Look at these price cuts. There's Kingwood. Here's King. We've been watching. Look at all the price cuts in Kingwood. Look at that. Look at all those houses right there. There's a new development right here. But anyways, guys, this is price cuts. We have so many price cuts. Let me show you guys new homes, okay? So if you want to look at new homes, you just put the year built in MLS. You just put 2022 to 2023, and that's going to pull up only new homes. Look at the results on the map. This is just new homes. Keep in mind. Look at actually over here. I saw like a huge cluster over here of new homes. It's like, look at 170, 162. What is this? So a huge like developments right here. So again, now that the weather is cool, like I may go out to this area and say, okay, why do y'all have 176 spec homes? You know what I mean? Why do you have 176 spec homes, builders? But look at all these houses. There's so much new building in Houston right now. It's absolutely astonishing. So again, I want to show you guys how to do something similar yourself as what I'm doing, because I am a realtor. If you're not a realtor, you don't have access to MLS. So what's, another, I don't want to say good avenue, but something you could do if you're in the state that is a disclosure state. Like, for example, California is a disclosure state. Texas is non-disclosure. But let me show you, okay? So you go to Zillow, okay? Again, I don't care about I don't want to know about active listings. I don't want to know about active listings, but I'm going to go to Zillow and I'm going to let's just select Las Vegas, okay? Now, first of all, what I want you guys to do is when you go here, you check sold. See that? So if you guys want to see what properties have sold for, it's important to understand what properties have sold for in what? The property's subdivision. If you know the subdivision you want to buy in and you don't have access to MLS, you don't have a great realtor, you should have a great realtor, first of all. But you go to Zillow and then just zoom in to the subdivision, okay? And you can see what homes are selling for. All of the stuff on the right here, I mean, they have 20,000 comps. So Las Vegas has 20,000 comps. Y'all see that? It says sold. All of this is sold data. This is so valuable. I can't tell you guys how valuable that is. So if you want to look at actual sold data, which again is my thing, that's why realtors are so important. That's why MLS is so important. You need sold data. Without sold data, we're blind. We need to know what things are selling for. We're completely blind. So again, you guys put in whatever area you want, hit sold, and you're going to be able to track that market. Now, let me show you something else. Okay, if you guys want to see foreclosures, now I think I showed you guys this on yesterday's video. I have another video, I'll show it too. But you go to more right here. Okay, you go to show more again right here, and then you just check all the foreclosures. Look at that. Let me go off. Okay, let me take that off. So agent listed, boom. I don't want that. I don't want new construction. Oh, you can also pick only new construction if you want to see that, but only want foreclosure stuff. Okay, so I apply all the foreclosure stuff. I hit apply, and now I have a list of all the foreclosures in Las Vegas. So this is saying I have 41 foreclosures in Las Vegas. Now, if you only want the map, just remove Las Vegas, and then you can zoom out. And you can see basically the foreclosures everywhere. Like, look at California. Okay, so here's a pocket in California foreclosures. Look at this. Of course, Los Angeles, because no one can afford to live in Los Angeles. But look at these foreclosures in Los Angeles. I bet you they're really priced high. Look at that. Oh my gosh, guys, look at this. Look at this first foreclosure right here. This first foreclosure is only 1,200 square feet, but it's $600,000. $600,000 for a 1,200 square foot house. And look at the condition of this house. Look at this house. Oh my God. California is so doomed. California is doomed. Oh my God. Look at the roof. So just know if you guys buy a foreclosure, you're going to have more than likely your work cut out for you. But anyways, I want to give you guys a little bit of empowerment. I know Zillow is a complete joke, but it gives you guys just a little bit more tools to use to empower yourself. So I'm going to go into our next video right now, which is this is our third video. Basically, this is another higher for longer video and the importance. So this person is going to talk about, it's actually a good thing that we have interest rates higher for longer. And then I'll go into why that is here in a minute. But you guys, please enjoy, and thank you for joining.
Joining us now, Sheila Bair, former FDIC chair and Center for Financial Stability senior advisor. I don't know, don't tell that to someone who wants to go get a mortgage or an auto loan or a credit card, Sheila. Why is it a good thing?
Well, I think, look, if money's free, you don't allocate it very prudently. And we've seen a lot of, bubbly conditions, a lot of silly stuff, attracting capital, a lot of consolidation, because a lot of that free money has been going into M&A. So all those things stifle innovation, ultimately hurt the economy and its ability to produce good paying jobs. It's not done much for wages at all. It's inflated assets a lot, which helps the haves over the have-nots. So I think there's a lot for Main Street to dislike about low interest rates. Now, yeah, I'm sorry, my mortgage was 9.25% in 1990 when I first got it. So I do understand, it's all relative to what you're used for. So interest rates, mortgage rates seem high compared to this extreme aberrational, like negative real rates for mortgages for so many years, which actually fed a bubble in the housing market and has contributed mightily to home prices going up so dramatically. And credit card debt, I feel you're paying, but golly, please just pay your bill off every month. Don't pay credit card interest. Don't carry it 25% too high. Use your credit card to make payments and for convenience, but pay that off at the end of the month. And the thing is, your opportunity costs are greater now because the money if you don't spend on interest, you can put in a bank account and get 5% now. It's been so long since we could get a decent rate on our savings account. So I think this is positive for Main Street as well. It's going to be painful to get the transition, no doubt about it.
But for small businesses, Sheila, it's a very blunt instrument, raising interest rates, and the smaller, weaker firms that need to borrow get hit a lot harder. And it really does separate the winners and losers. And the bigger companies with scale that are safer have a much easier time dealing with it.
Well, I would argue that that's exactly what was going on with zero interest rate policy. And there's a lot of research on this showing that it disproportionately benefited the larger companies that could access capital markets, not so much the smaller ones that had to go for bank loans. The regional and community banks, who do the lion's share of small and medium-sized business lending, were killed by zero interest rates. You want to know why we don't have many new community banks over the past several years? If your business model is to take deposits and make loans and make money off of the NIM, it was very, very difficult. In that interest margin, it was very, very difficult to make money. So this is going to be painful to everybody to get through this. But once we go back to a more normalized environment, you're going to see more robust credit availability for the small and medium-sized businesses and less disparity between the funding costs of the large guys and the small ones.
Although I know if you chart, say, the S&P versus the Russell 2000, they traded pretty much in line until about March, when we know what happened in March. And since then, they've split, and it's the big corporates that have performed better because some argue these maturity walls are a lot more intense for smaller companies. Is that not right?
Yeah. Well, I think there's a lot of big companies that have a lot of debt resetting over the next couple of years, too. Yeah. So I'm not sure. I think there's going to be some pain for the larger ones as well. But look, this is going to be a difficult transition, but it's important to remember historically, interest rates still aren't that high. We were in an aberrational period of zero to negative rates. We're normalizing now. There will be some pain in the transition for everybody. But when we get to the other side, this will be better for small and medium-sized businesses. It will be better for small and medium-sized banks who can then finally, we need to normalize the yield curve as well, but who can finally make a decent spread. If interest rates have hit the zero bound, it's very, very hard to make money, taking deposits and making loans. So I think, again, when we get through this, it will be a better thing, not a worse thing for Main Street.
Sheila, you guys, I'm gonna say I absolutely agree with her, and I'm gonna also just remind everyone, also Johnny, the MREs. This is what I love for MRE. I have MREs all the time because I go on all kinds of adventures, but the thing is, guys, is we're in this situation because of the low interest rates being too low for too long on top of the money printing. If we have low interest rates, it's going to kill us. It already is killing us. I think I think most people would agree with me on that. Living in Omaha, dude, are you doing your own research or what? Like, I want next time you do some comments, man, I want to know that you are doing the work and you're looking at yourself, because obviously what he's saying is if currently we have an abundance of new construction, won't builders put the brakes on building going forward? Bro, just go to the new permits. Okay, just go to permits. Do you see the decline here? So yes, Omaha, yes, that's correct. That does mean that, and that's what we see here in this charts right here. But we will see this actually continue to go down if the collapse continues to happen. But just to let you know, Omaha, yep, you're right, buddy. See this graph right here? It is going down. So appreciate you participating, man, as always. Let's see what we got next here. I think was that our last video? I don't think that was our last video. It's almost our last video. It wasn't our last video. We have to look at this. All right, so here's what the market is now. Let me refresh this. Okay, so we got the hot numbers out this morning. Retail sales. Let's see if the market, oh my gosh, that's insane. So the market has changed. So they're saying 10% likelihood now, 10% of a rate hike in November. This was at like what, 4 or 5%? Let's look at December. Big change in December at 42%. So that went up. So after that information came out, that went up. So they're almost not quite, almost 50-50 now as far as the market pricing in a second rate hike this year, or a final rate hike this year. Let's go into mid next year because we need to kill seasonality next year. Okay, so July, this is looking way better. This is good news. So July is sitting at about 36-37% likelihood to remain elevated. Remember, that went down to the low 20s. So this is really, really good. So we're at like 37%. This is really, really good. And again, why is all this happening? You guys should be starting to kind of like figure out these patterns. Why does that happen? Why does the market say 1 minute there's going to be no way they're going to raise rates in December, and then the next minute, well, they actually might raise interest rates in December? Why does the market keep getting it wrong? Inflation. No one wants to talk about inflation, and no one wants to talk about the inversion of the yields. The inversion of the yields is a historical precedent of caution, of incoming, not here yet, incoming economic pain. I don't know why that's so hard for some people to acknowledge. But anyways, we're going to listen to our last video. This is going to be a really good video, you guys. I have some questions for you after you watch this video. But essentially, this is going to be someone basically saying that the economy is my focus, okay? That the economy is incredibly strong right now and is getting used to the 4.5% and 5% interest rates. But my question is the economy getting used to no stimulus? And really, is the economy hot because of the stimulus? And also, what would happen and where we would be at in the economy if there wasn't an overabundance of fraud and stimulus? Would our economy be this strong if it wasn't for the historical, unprecedented amount of money printing? Come on, guys, right? I mean, seriously. But anyways, listen to this video. It's actually a really good video. Hope you guys enjoy. This is our last one.
Picking up steam this week with more than 50 S&P 500 companies and 5 Dow components set to report results. Joining us right now is Ed Yardeni. He's the president of Yardeni Research. How are you setting yourself up this morning, or maybe even I should have said last week, ahead of everything we've already started to hear on Friday?
Well, to tell you the truth, after hearing that report that you we all just heard from the Middle East, things look just basically horrible over there. Yet, the market's hanging in there pretty well, and I think that's because we've had several of these crises and conflicts between Israel and Hamas that led to ceasefires pretty quickly. This one looks like it's going to linger. And yet the price of oil hasn't really shot up. But I'm accentuating the positives here in terms of what the market's focusing on. And that's, as you said, it's earnings. I think it's very likely that when all the earnings come in, that the third quarter is going to be at an all-time record high for S&P 500 earnings, which is pretty impressive all in all, since the Godot recession, the most widely anticipated recession of all time, just has been a no-show so far.
So, Ed, though, think about how do you think about those earnings? And I know it's just impossible to put these things together with what's happening in the Middle East and what you think the larger geopolitical implications are, and therefore for the broader market. So we could have amazing earnings, but it's not even just what's happening now. Obviously, stock prices are looking out, call it 12 months, 18 months out. Where are we then? And how does this situation factor in? Recognizing, interestingly, at least from the academic studies that I've seen, and just, you look at charts over the years,
Right.
with the exception of what was taking place in Israel in 1973, for the most part, when there have been problems in the Middle East, they have not impacted the stock market as negatively as you might imagine
Correct.
they would.
Correct. Well, I think the obvious example of when the Middle East really did have a tremendous impact on the global economy and certainly on the stock market was back in the 70s when we had two energy shocks in 1973, and that was related to a war between Israel and the Arab states. And then in 1979, when the Iran Revolution occurred, oil prices soared a lot more than they've increased so far since the summer. And as a result, I think the market is looking over the next 12 months and concluding that this too shall pass. One way or another, the situation will be stabilized. And if that's the case, then the outlook for 2024 is probably pretty good.
Okay, but here's the thing, prior to a week and a half ago, where was it a different debate about not whether things would, putting what was happening in Israel aside, because it hadn't happened yet. There was just a fundamental debate about whether we were headed towards a recession, how
Correct.
deep the recession would be, and whether, frankly, 2024 or 2025 actually wasn't that it was going to be positive or stable, it was going to be bad. I mean, that was, I think there was a lot of people that were concerned about that.
Sure. Well, look, one of these days a recession is going to happen. The business cycle hasn't been, forever banned. And I do think that the outlook for now is pretty good. I mean, the economy has proven to be remarkably resilient. It's true that we've seen this tremendous increase in short-term rates and the bond yield, and yet the consumer continues to spend. There's still a lot of fiscal policy stimulus in the pipelines. Companies are investing in artificial intelligence and so on. And as you know, we had a really strong GDP during the third quarter, which is why earnings are probably going to be at a record high. So I think the economy has proven that it can actually live with 4.5% to 5% bond yields. Obviously, if we go a lot higher than that, Jamie Dimon of JP Morgan has been saying, these are extremely dangerous times. And yet his bank reported tremendous upside surprise earnings in the third quarter.
Okay, so surprise upside earnings in the third quarter, but they never talk about they never talk about the inversion of the yield curves and what that could mean moving forward. Do you guys think that we're going to have the all-time record high Q3 of 2023? Do y'all really think that? Do you think it's a result of the inflation? Do you think it's a result of consumers getting into more debt? And what about the corporate bankruptcies nearing great financial crisis levels? What about that? Let's just talk about the corporate bankruptcies. Corporate bankruptcies are almost at 2010 levels. And if we count the COVID lockdowns, we're only 2 bankruptcies under that. We're at historical levels. Literally every consumer debt sector right now, the defaults are over pre-pandemic. Think about that. That means the money is almost gone. All the uncertainty is starting to sink its teeth. And all of the times we hear Jerome Powell say, you have yet to feel the full effects. They're starting to feel it. I think they're starting to feel that. But the market is just so delusional and foolishly optimistic. I just don't think they see it. And real quick, I saw your comment, Omaha. I do want you to comment. I didn't know if you were being sarcastic. I'm really sorry if I took you the wrong way. Sorry about that. Please don't go anywhere, Omaha. I appreciate you. What is this here? So good comment. I'm going to pull up some stuff right here. We're going to go into the Q&As. But before we do the Q&A, I want to show you guys something real quick if you're interested. Now, let me see. Where do I want to go? I'll go here. So if you guys are interested on the progress of my home buyers course, I'm not saying to buy right now. I'm saying to empower yourself right now. And actually, overall, I'm saying 100% do not buy right now. But if we're on the sidelines, I'm making a free home buyers class. Now, I've released the first chapter. There's 4 chapters. I've released the first one to members only because I'm hoping to get, obviously, I want to get their criticism back. This is my first online course. So I'm sending it there first. It's really cool, guys. So if you're interested, when you click the link, something like this will come up. But here's what the actual course looks like. I hate this thumbnail and I don't know how to change it. It's making me so upset. I don't know the whole system, but I really hate it. It was just an example thumbnail, but this is really cool. If you guys want to come here, for example, first chapter's on purchasing power. We talk about credit, income, assets, and a mortgage. I'm not saying to buy. I'm saying to educate yourself, right? Don't buy. My God. Someone was like, how could you, Travis? You're trying to sell a home buying class. It's a horrible time to buy. I'm like, duh, you're not listening to me. I'm like, yes, but we don't want to just sit on the sideline twiddling our fingers. We want to empower ourselves and grow. So this is like the mortgage, right? I do a summary, mortgage lesson 101, a little recap, and this was actually a really good one. This is on mortgage. So I have a whole bunch of, points and stuff like that. And then, our quiz. And then the cool thing that I really like about this is we can talk to each other. So I am blessed. Actually went, I think, through the entire thing last night because I got this out last night. And she put comments there. So I think it's really cool because we can continuously talk to each other. And I like that part. So if you guys are enrolled in the home buying course, please give me constructive criticism. Please let me know if you enjoyed the flow and if you're getting value, because it's the testimony that's the most important thing. The class doesn't matter if you guys aren't learning. So please, if it is, and it's free, you guys, I'm not charging you anything. So please just let me know how I can improve if you do take that. I hope that the entire course will be ready maybe at the end of this month. It just depends. It's very tedious. I'm going to throw up some comments now. First one is this is basically stating the antidote of high interest rates is not refinancing. It's the low prices. Okay, guys, let's talk. Okay. So, I don't want to use any names. I don't want to bash anyone. So I'm just going to say goober. Okay. So I know this guy, we'll call him a goober. And, his thing is like, this is the crash. Like right now is the crash, and the crash is in sales. All right. Crash is a transaction crash. But I think it's really important to understand the cycles, the stages. And remember, you guys, what's the first stage? The first stage, number one, first stage is what? Interest rates. Okay. So stage one, interest rates. We got that. Stage two is what? Sales and new construction. Okay. Sales is in the toilet. That's crashing. New construction also in the toilet. We see that with prices and incentives and things like that. So that's the stage that's doing really well. But what's the third stage? Prices. What's the fourth stage? Inventory. Okay. So what does it mean if on the third and fourth stage where we had price declines and we have inventory growth last year? So we did have all four stages last year going on, but something happened. And those stages stopped. So you have to ask yourself, why? Stage one, interest rates. So what I believe is during the course of the run up this year, interest rates were too low. Stage one, interest rates were too low. Even though sales were still crashing, even though new home construction sales were also crashing, interest rates were not high enough to crush demand enough. Interest rates were not high enough during, March to about August. Interest rates were not high enough to crush demand enough to have more inventory and lower prices. It starts with interest rates. So I think that these guys that are celebrating like super early are like mistaken on where we're at in this whole thing. I mean, we're literally, you guys, Jerome Powell is telling us right now, we still don't even feel the full effects. Our government is telling us right now, be careful. You don't even know what's coming yet. They're telling us that now. And people are taking victory laps, selling toxic assets to people. Just be cautious. Now, having said that, I'll still admit that there are some deals out there. There are some people that are purchasing wisely. It is just very, very rare. The great majority of people can't even afford a house. And the great majority of people, we need a reset in the housing market. I think that's fair to say. So, going back to that question, I mean, we need lower prices. Refinancing is horrible. Some really good comments from House Hacker this morning. It's the same thing here in San Diego. I saw a listing, a lady bought blah, 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 and her mortgage payment is $8,000. So here's how I think California can crash, House Hacker. Because remember, you guys, I had a foreclosure myself in Southern California, right? So I had that happen. But look at the negative cash flow. So their mortgage is $8,000, but they're trying to rent for $3,200. That's a type of kind of like a speculation or chasing future equity growth. When you chase future equity growth and you don't have positive cash flow, it puts you in significant danger unless you're a mega investor that has enough liquidity to bail yourself out. Most people cannot bail themselves out. And I'm going to tell you, House Hacker, I remember during the great financial crisis, I was in a taxi. I don't remember where I was going, but I was in a taxi ride and the taxi driver was telling me, I got 8 rental properties. And when he said he had 8 rental properties, I'm like, there's something wrong here. You got 8 rental properties, but the thing is, he was upside down in all of those houses on equity and in payment. So when the recession finally hit, boom, lost everything overnight, because no one prepared back then. So that's why I'm constantly, House Hacker, trying to tell the viewers how important cash flow can be and to treat your primary residence like an investment. Here's another thing, you guys, from Florine. Our corporations are forced to explore AI to stay alive, therefore more unemployment in the next decades. Brave new worlds. And that's another thing that no one's even talking about, the AI. We're going to have unemployment just from quantitative tightening and the high interest rates. All the full, oh yeah. So I addressed that. I'm talking about the job numbers, the job growth numbers, right? Like new employment numbers, right? Okay. And then Island, Eric, someone asked me, thank you. No, I got beat up. And I made a video of my shark fishing adventure and I posted it in my members only community tab. It's my content for my shark fishing videos. It's a little rugged. So if you kind of maybe have a weak heart, don't watch it, because that's the thing that I do. It's weird. Okay. I know, but I got to be like a dude. I got to be with the guys and I got to be like a little reckless. So my videos are a little bit rough. But if you want to watch Island, it is in my members only section, or just go to my other channel called Spartan Tackle Fishing. Spartan Tackle Fishing. But forgive me, I'm telling you guys, those videos are wild. Another great comment. It will cost you, okay, I want you guys to think about what I'm about to talk to you about. Good job, House Hacker. You're on point this morning. It will cost you more money if you have tiny homes. You can find 2 for 1 for $60,000. You find out the cost of install electricity. Okay, so here's what he's basically saying. Do the stuff yourself. If you guys pay for someone to do like upgrades or flooring or like any of that type of stuff, they're going to charge you 2-3 times more than what it would cost you to do your. So in other words, if you're going to build, start with a friggin' shed. And I'm saying that because that's what my wife's parents did. They started with a shed from Home Depot, and then they got the drywall up. Then they put like plumbing in and electricity in, and they must have saved $30,000-$40,000 by doing that work themselves. So they took shed, did the work themselves. So that's great, House Hacker. You guys, I'm not saying now's the time to buy, but we definitely need to be, if we are buying right now, we need to be very careful. And if we are investing right now, we have to be very careful because it is really scary out there. Next comment right here. You guys may already know this. Sometimes when you look at Zillow and your phone versus your computer, you get different numbers. And you know what, guys? That's true. That happens to me as well on MLS. Like I get different data on my phone versus when I go to my desktop. Now, I just wanted to say that does happen a lot. But what I noticed is sometimes when I look on my phone, it has different filters. So like I'm not justifying, dishonest data, but I'm saying what I noticed, because I was like, why is my data different on my phone versus desktop? I noticed, brother, that it was because my filters were different on my cell phone. But still do your research, okay? And let's see, do we have anything else, you guys? We have any? I don't know. Hopefully he's being nice, but I love that screen name. I really love that screen name. You guys, I hope you're doing well. Happy Tuesday. Say a prayer for Israel. Say a prayer for all of the stuff that's going on. Say a prayer for yourself. I hope you guys remain positive. I hope all of this was good. And again, if you've already enrolled in the home buying course, please take it. I'm only trying to empower you guys for free and giving back to you. It's a tremendous amount of effort. I'm going to try to do the best I can to stay on lives. But again, I want to get this home buying course ready for you guys. I'm going to have a foreclosure video out tonight, and I probably will do a live tomorrow because we're going to hit a new record. So again, you guys, I'm telling you right now, you heard it. Wolf, I see you, Wolf. Oh my God, it's been a long time. So again, mark my words. I'm saying right now, you guys are hearing me right now. By the time I do my live tomorrow morning, we will have a new record high interest rate, at least for this cycle. It's going to be over 7.81. Mark my words, by tomorrow. Now, other than that, guys, keep on learning. Stay positive. Have a great mindset. Don't take things too personally. And always improve your purchasing power, credit, income, and assets. And love some people, you guys. And if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.